Okay, so welcome again, Professor Prescott. Professor Prescott is joining us from the University of West Florida, which is in Pensacola, Florida. And I've had the opportunity to be Professor Prescott's student. The first time I had him was in 1997 in the first cost accounting class. And that's actually when I decided to continue as an accounting major. Before that, I was, not sure. But he really not only inspired me to study accounting, but eventually inspired me to teach accounting. So, I could talk about the next hour about Professor Prescott's influence and how he guided me throughout the years. So without further delay, just one more thing I want to mention about Professor Prescott is that he has years of experience working at a bank, which is a regional bank called Compass Bank, and he worked in commercial credit. So his discussion today is also going to reflect his years of experience as a financial analyst for the bank. So without further delay, I would like to hand it over to Professor Prescott. Please take it away.
Thank you, Dr. Sadula, and thank you for the kind words. I appreciate that, and I appreciate the opportunity to be with you today. Let me go ahead, can I share? It says.
Okay, let me make you a moderator. That way you can. Okay, now you can share now.
Okay. I'm gonna have to close it. I didn't know it had to be closed.
So on the right side, you see the share now, the box,
yeah, but
the arrow coming.
I had the file open because that's what I have to do. Now it's opening. So I had to close it so that I could access it.
Okay. Okay, there it is.
Yeah. As Dr. Sadula indicated, I had a career in commercial banking that lasted about 25 years, and I was in charge of the commercial credit department in Mobile, Alabama. We had to evaluate commercial customers for their loan request. And those loan requests, typically, I led a team of between 5 and 7 financial analysts. Several of them were CPAs. We had to write formal reports, either recommending or not recommending commercial credit facilities that ranged in size from $1 million to $75 million. $1 million being the smallest credits that we would get involved in. And the 75 million typically were oil and gas exploration credits that were done out of our Houston, Texas office. We had to evaluate credits in a wide variety of industries, such as hospitals, fuel jobbers, over-the-road trucking companies. Seafood processing is a big business in South Mobile County. Construction contractors of all types, as well as oil and gas companies. So for a lot of different industries that we evaluated, we often had to, there was a learning curve. You had to learn what are the important aspects of this business and how do you go about assessing those different aspects of the business as you go through it. The greatest difficulty that I had in all the years that I worked at Compass Bank was hiring people who could write. I had a lot of people who were skilled they could explain to me orally what was going on with the company by looking at the ratios, looking at the financial statements of a company. They could tell me what was going on. But when I would say, okay, now go write that, they could not write the report effectively. And as I'm going to say later in the presentation, financial analysis is an art form. Different people can disagree with conclusions. So we had to write our reports persuasively to try to communicate what we thought were the risk factors inherent in the financial condition of each individual company. And we would have to assess whether those risk factors tilt to the side of we should make the loan or tilt to the side that we should stay out of the credit facility and not make the loan. And believe me, when you're talking about a 10, 15, $25 million credit facility for a $50 billion bank through the Sun Belt in the United States, that was a big credit facility, and we had to be very careful that we knew what we were doing so that we made realistic recommendations. In your coursework, I have taught classes before in an MBA program and include financial statement analysis as a given chapter. Please understand that all we do here, all we can do in a chapter in a textbook is give you the basics. There's much more to it than you actually might think, than you would get the impression when you go through a single chapter. For example, we're going to talk about probably no more than 15 ratios today. There are literally hundreds and hundreds of ratios that can be calculated for different types of industries. Some of the tools that we used that are used in the analytical process, whether you do it in a commercial banking environment or any other environment, are number one, we would use a spreadsheet program. Our spreadsheet program looked an awful lot like Excel, but we would put stuff on an operating line if it were an operating asset or liability, or if it were operating revenue or expense. And we would put stuff on non-operating lines if they were non-operating items, so that it generated a cash flow page that segregated operating activities from non-operating activities. We would also do horizontal or trend analysis. If you have your financial statements on Fred's Inc., if you look at the income statement, it says consolidated income statements. I believe it's table 2 that I have. If you look from fiscal year 14 to fiscal year 15 to fiscal year 16, 17, and 18, by looking at net sales as you go from one year to the next, you are doing horizontal analysis. Horizontal analysis is referred to as trend analysis. You're looking for, is there a trend with respect to revenues? And in this case, revenues went from 1.97 billion to 2.15 billion to 2.12 billion to 2.08 billion to 1.69 billion. So initially there was an increasing trend between 14 to 15, or not a trend, just an increase. But then beginning in 16, fiscal year 16, the revenues of the company started to decline. And in fact, the company declared bankruptcy in 2019. So there's just a simple example of trend analysis, looking at a given account across the different fiscal years to see if you can discern any particular trend that might be happening. Another tool that we used an awful lot is vertical or common sizing analysis. We're going to do a little bit of that when we calculate the profitability ratios of Fred's a little later in this presentation. But vertical analysis is you're staying within a given fiscal year and you are comparing various ratios, for example, a gross profit margin, an operating profit margin, and a pre-tax profit margin, you're taking numbers in the income statement column and dividing them by some base amount to express them as a percentage. And we do that for profitability ratios. Like I said, we'll do that a little later in the presentation. Probably the biggest tool that we used were ratios. Ratios are simply the comparisons of two or more numbers that someone has determined have a relationship to each other. For example, one of the liquidity ratios that we'll talk about in a few minutes is the current ratio. Somebody decided that the relationship between current assets on the balance sheet and current liabilities on the balance sheet means something. They tell you a story, they tell you something. So we only calculate ratios between numbers that we think have some type of relationship to each other that tells us a story. And then the big thing that we focused on at the bank, and that I had the hardest time getting my employees to be able to determine, is to emphasize trends that are going on. People like to talk about what is the current situation, but that's not what I cared that much about. I mean, if we're in the business of making a $10 million loan to this company, we want to know, are they going to repay us over the next 5 years as the loan requires? So I'm more into looking at trends and seeing if I can predict the future. What are the trends that tell me, is the company likely to be able to repay this loan in the next 5 years along the terms that are being issued or not? And the reasons behind those trends. Why are things getting better? Why are things getting worse, if that's the case? So it's not just telling me what a ratio is, but it's telling me why it's getting better or why it's getting worse. Now, I'm sure your textbook goes through a lot of different areas of financial condition that can be evaluated. And they probably group some of the ratios that your book has in it a little differently from what we did at the bank. We had liquidity ratios, we had financial leverage ratios, we calculated some profitability ratios, and then of course, because we were a financial institution, we wanted to assess the company's ability to service debt, both the existing debt that's on the books already, as well as any loans that we might be considering making at this time. Okay. So now let's go through what is liquidity. What are we trying to assess when we evaluate a company's liquidity position? We are assessing the firm's ability to generate sufficient cash to meet its obligations in a timely manner. The higher the degree of liquidity, the lower the level of risk that is inherent in the company's financial structure. The more liquid a company is, the more able it is to absorb any unusual events or any unexpected. For example, the bankruptcy of a large customer. If a company has significant liquidity and has a customer that owes it a significant amount of accounts receivable, and that company declares bankruptcy, if the company has ample liquidity, that one receivable becoming uncollectible will not necessarily impact the overall liquidity state of the company in question. I have on the slide here an example of Kmart. I don't know if you're familiar with Kmart. Kmart was a large discount retailer, kind of was the forerunner to the Walmart chains in the United States and abroad. Kmart was struggling financially. It was in its last years of existence, and I read this about this in Fortune magazine several years ago. Scott's, the fertilizer company and lawn care company, contacted Kmart in the spring or early spring, like in February or March, and said, because of how much you owe us, already, and because of how old the receivables are, we will not be shipping to you new products for spring. And of course, in the United States, at least in the spring, people get out and start doing work in their yards and improving their landscaping and things like that. And Kmart knew that if they did not have the products that Scott was their supplier for, that they were in trouble. And after they received that communication from Scott's, the board of directors of Kmart had an emergency meeting over the weekend, and on Monday morning they declared bankruptcy because they knew if their suppliers started cutting them off, they are not going to be able to be in business. They got nothing to sell. So liquidity, while a lot of people do not assess it as being that important to the overall financial condition of a company, I'm one who believes that liquidity is extremely important. For example, if you do not have the cash to pay your employees on payday, see how many of them show up the next day for work. I mean, liquidity can put you out of business quicker than poor profitability, than a high degree of leverage, anything else, in my opinion. The next area of financial condition that we evaluated was financial leverage. I mean, if you think about it, a company has a given level of assets. These are economic resources that the entity owns or has acquired the right to use. The question is, how did they obtain those assets? Did they fund the assets with liabilities? Did they borrow all the debt related to those assets? Or did they fund it with equity? Those are the two sources, liabilities and equity. If you think about the accounting equation, assets on one side, where do they come from? Either liabilities or they come from equity or a combination of both. And so financial leverage, we're assessing the degree to which the firm relies on external sources to finance its operations. And the higher the degree of financial leverage employed by a company, the higher the level of inherent risk in the firm's financial structure. And we will calculate financial leverage with a single ratio, so it's relatively easy to interpret. The next area was profitability, and this is the one that most of my employees were really good at evaluating because it's pretty straightforward. In profitability, we are assessing the degree to which the firm is operating effectively. That is, how well is the company's management utilizing the assets that the stockholders have allowed it to acquire in order to generate a return to the firm's owners. And stronger profit margins equate to a much lower risk profile associated with a firm structure. The more profitable a company is, the better able it is to absorb a stress, new competition, or COVID-19, a pandemic hitting it. So the more profitable a company is, the more flexibility it has in its business strategy to adjust to unexpected events. Now, your textbook probably talks about ROA or ROE, that is return on assets and return on equity. I'm not a big believer in ROA and ROE, and it's for this reason. If you think about it, in order to have assets, a company may lease those assets, or it may purchase those assets outright. If you think of a company that leases its assets versus a company that has its assets on its balance sheet, even if they have exactly the same net income on their income statement, the company that leases its assets will have a higher ROA than a company that has those assets on its balance sheet. But if you own the assets, you will eventually pay off the debt related to them, and you won't have those debt servicing obligations going forward. If you lease the assets, however, you're going to have to pay the owner of those assets a lease expense or a rent expense in order to be able to continue to use those assets in the future, no matter how long you have leased them. Excuse me. And also the ROE equity. Excuse me just a second. With ROE, think about it. If a company has low amounts of equity, in other words, it's highly leveraged, you would have a higher ROE. So it doesn't make sense to me to evaluate companies based on ROA or ROE nearly as much as it makes sense to look at income statement ratios to evaluate a company's profitability. And then the last area, and then we'll start calculating some ratios.
Professor Prescott, I have a question before.
Okay.
So if you can go back to the previous slide.
Yes, sir.
So when you're talking about the leased, the companies that lease the assets, you're talking about definitely the operating lease here, not the capital lease. From your experience, do you find a lot of companies that came to borrow from Compass Bank with a load of operating leases? I mean, are there a lot of companies that do that?
Absolutely. Like and a lot of think of a closely held company, a company that is owned by an individual and may have 3 or 4 locations, retail locations. Oftentimes, for tax purposes, the owner of the company will own the assets and will pay himself lease expense. So he's effectively kept the assets off the balance sheet of the company. So he would have a higher ROA than a company that owned all the assets and put them on their balance sheet. Also, there are companies like grocery chains that lease their locations in retail shopping centers and such, and so they typically do not own. A lot of trucking companies will lease their tractor trailer rigs as opposed to owning them. So it's very difficult to assess the degree to which the ROA may be overstated as a result of such. And there's nothing nefarious about what the companies are doing. It's just, for example, the principal may say, I want to take this compensation out in the form of lease expense as opposed to salary expense because I don't have to pay payroll taxes on lease expense.
Okay, so I was just thinking that the duration of the lease would not qualify it as an operating lease, but that's not the case, obviously. The life of the asset is much longer than the life of the lease, right?
Right, yes. I mean, because they could sign a series. In fact, many times the CPAs would structure the lease in such a way that it had to qualify as an operating lease. For example, it would be a 1-year lease with annual renewal options. So even if they really intended to use it for the next 25 years or 15 years, they would structure it in such a way as to keep those leases off the balance sheet. Now, the new lease accounting standard is changing some of that, but that's just one example of why I don't really rely on ROA. Now, in the banking industry, banks are not allowed to keep their assets off the balance sheet like that. So ROA for a bank is a more representative measure of profitability than for most companies, in my opinion.
Okay. That makes sense.
Okay.
That answers my question. Thank you.
Sure. And then ability to service debt. This was, no matter what everything else said, if liquidity was excellent, leverage was good, and profitability was excellent, if the company could not service its debt per the terms of its existing liabilities and any new loans that you were going to make to them, we didn't want to be involved in it. So the ability to service debt section assesses the degree to which the firm's funds available for debt service, and we'll show you how we calculated that in a minute, meet its debt servicing obligations. You're looking for coverage. How safe is your debt servicing coverage ratio? And the greater the margin of safety in a firm's debt coverage ratio, the safer its financial structure. I teach at the Alabama Banking School every year, and I co-teach with a bank president and have for the last 15 or 20 years. And he likes to say that debt service, he shoots for 1.25 coverage. And what he means is his loan policy calls for 1.25 as the minimum debt servicing coverage. But because he's trying to make loans, he shoots for 1.25 as his target. That's what he's looking for. And my point is 1.25 doesn't offer you much of a cushion should something like COVID or new competition or any technological developments come into place. So we have, again, we have a difference of opinion based on our perspectives. Okay, so now let's go ahead and calculate. As I said earlier, we have 4 liquidity ratios that we use. So if you will get your Fred's consolidated balance sheet page, we're just going to calculate it for 2018. Uh-oh, something's wrong. It changed the formatting, Dr. Sadula, when we did this. The current ratio is total current assets divided by total current liabilities. That's how you calculate it. And if you will look at your FYE 2018 balance sheet, total current assets are 315, 326. Those are millions of dollars, $315,326,000.
Do you guys find that on the financial statements? 2018 balance sheet, total current assets. Yeah. 315,326 million dollars.
Yeah. But don't worry about the extra. Just do 315, 326. But these are all in rounded thousands, so you would add 3 zeros to it. But don't for calculating. If we leave the numbers simple, we can calculate them and get the same result. So 315, 326 for your total current assets. And then further down your balance sheet, when you go to the other side of the balance sheet, you see current liabilities, 214,099.
You see that number? 214,000.
Do what?
Yeah, no, I'm just talking to the students. Are they able to locate that number? Yeah, they all everybody located the numbers.
And if this slide were formatted correctly, I would tell you that first of all, the X there means that this is a coverage ratio, and the arrow pointing up means the higher, the better. In this case, when you take 315,326 and divide by 214,099, you get a result of 1.47 times. Your current assets cover your current liabilities 1.47 times, or almost 1.5 times. If you took all of your current assets and converted them to cash, how well could you cover your current liabilities? And you could cover them about 1.5 times. Okay. Now, the quick ratio says not all current assets are created equal. Some are closer to cash than others are. And so in this case, the quick ratio says, I'm going to take cash plus any marketable securities, plus any accounts receivable net of the allowance for doubtful accounts, and I'm going to add that by total current liabilities. So in essence, what I'm throwing out here are 2 things: inventories and prepaids primarily. So it's more of an acid, your book may refer to this as the acid test ratio. It's a tougher version in assessing liquidity. So in this case, I show you that 3353 plus 22,970 plus 3412 is the numerator, 58,735, and you divide by the same total current liabilities, 214,099. And in this case, you have a quick ratio of only 0.27. So this tells you that the company is heavily dependent on inventory turn, being able to sell its inventory in order to meet its liquidity needs. Because of the gap between the current ratio at 1.47 and the quick ratio of 0.27, that's a big gap. So that means this company is heavily dependent on inventory, being able to sell its inventory in order to meet its liquidity needs, which makes sense because Fred's was a small discount retailer that focused on communities typically of less than 20,000 population. They're like a very small Walmart store of 10,000 square feet, as opposed to 100,000 square feet or so. But that means since we've got this big difference between the current ratio and the quick ratio, we probably need to look at inventory turn and see how well the company turns its inventory. Oh boy, I worked so hard to get these things formatted correctly and they've messed up. Okay, so in this case, the receivable turn period, now this is a measure of how long on average it takes the company to collect its receivables. Now in this case, it's receivables. When you go to a store like this, they don't allow you to buy on credit. You use your credit card or you pay cash, and then they collect the credit card collection is from the credit card company. So you don't come in next month and pay them for last month's bill. So I'm not surprised that the receivable turn period is every 5 days because they sell primarily for cash. That makes sense to me. But what I'm really interested in is what about inventory turn? How long on average does it take this company to turn its inventory? And the answer is 69 days, which I think for a company like this, that's a long time. Now, of course, we would need industry standards. We need to look at the retail discount retailing industry to look up an industry norm to see how that 69 compares. Plus, I would also want to look at, I would calculate the ratio for all 5 of the years that I have, and I would see which direction is that 69. Am I going from 80 down to 69 over the last 5 years, or am I going from 36 up to 69 over the last several years, in which case I would not be happy. I want it to be the quicker. That's why the arrow is pointed down. The lower, the better. And then at the bottom, I do have an asterisk that says, if you have a rapidly growing company, you might want to use the average of accounts receivable in the receivable turn period and the average of inventory in the inventory turn period to get a more realistic. And the average means the beginning of the year balance for accounts receivable plus the end of the year balance for accounts receivable divided by 2. And then the beginning of the year balance for inventory plus the end of the year balance of inventory added together and divided by 2. Okay?
So you have a question, Greg, from a student.
Okay.
Go ahead, Rashid.
Dr. Prescott, can you hear me?
Yes, sir, I can.
First of all, I would like to thank you for your time. We are really honored for being here today with you. I would like to extend my appreciation for you, Dr. Shahriar, for giving us this opportunity to have some of your valuable knowledge in this field. Frankly speaking, I'm trying to wear the hat of the creditor, and I'm trying to sit on the other side and see how can I evaluate things in order, to give this X company a loan or not. And you did mention a very important point, and I would like to dig into some more information in terms of the current ratio, the inventory turnover, and these things. What I've learned in the past month in the MBA, current ratio it's like a safeguard of the company that whenever we need a cash, we need to liquidate these cash and pay our obligations, which is, as a creditor, it should be a good indication for us.
Right.
Again,
Exactly.
for the inventory turnover, I don't know whether I'm saying this correctly or not, but it's a kind of showing me how active the operation of the company and converting their goods into cash. And I think you just mentioned it a few minutes ago. So being a creditor, seeing these numbers, it's going to give me a kind of a flavor how active this company in terms of their sales. However, there is one point. I'm trying to make my question no more direct. You just mentioned that 1.2 of liquidity, or sorry, current ratio, you're not a big fan of this number. I did my small research, Dr. Prescott. In the industry, for the service industry, the ranges varies from 1.4 to 1.6. So I am a chemical engineer. I'm not so experienced in this field. And I do believe into the benchmarking language. Don't you think this value is a good enough for a decision criteria for loaning this company? This is my question. Thank you.
Okay. Good question, and thank you. I appreciate the opportunity. Very good question. What I would say is that in evaluating liquidity, you cannot look at just one ratio, because you look at the difference between 1.47 as the current ratio and the 0.27 for the quick ratio. Now, you said that you looked up an industry benchmark and you found it was between 1.45 and 1.65. So this company appears to be at the lower end of the current ratio range. What did you find when you looked at the quick ratio for this industry?
Thank you for this question, Dr. Prescott. In terms, looking at into the strategic point of view, I think a smarter company, they wouldn't end up using their quick ratio. It's all about management decision, if you do agree with me, Dr. Prescott. So even as a creditor, if I started to see how frequent this company is using the quick ratio, I do think they do have a bad management, because as a management for a company, we should be foreseeing things before it happens. And this is basically what you do, Mr. Prescott. You're predicting the life of the company and how good they're paying their debts. So most of the articles I've seen, companies were depending on the current ratio more than the quick ratio. I don't think companies, they're going to be revealing that they do have some a popped up situation immediately, and this is where they're going to be ending up using their quick ratio. But I do agree with you, their quick ratio is, comparing to the market, they're not doing so well. At least they should vary between 0.1, something like that. Thank you for your time, Doctor.
Sure. And again, I would caution you, we don't have time here to calculate these ratios for all 5 periods that you had the information for. I would not just look at 1 year of any ratio and try to make any kind of a conclusion. I would want to look at, where's this 1.47 compared to what it was in the 4 previous year ends. And I would also want to look at the quick ratio the same way. And I would want to look at the receivable term period and the inventory term period. Again, I would tell you that if the inventory turn period for this company has gone from every 30 to 35 days in 5 years ago to every 69 days now, I would tell you that that is a cause of great concern. I don't care what the quick ratio tells you or the current ratio tells you. This is a retailer that is in business to turn inventory. And if its inventory is slowing that much, that dramatically over 5, and I don't know that it is, I'm just telling you, maybe 69 days is the best it's been in 5 years, I don't know. But if it were calculated over the 5-year period, I would look at all 5 years. And our spreadsheet program showed us the balance sheet information, the income statement information, the cash flow information, and the ratios for all 5 years, if we had 5 years of data. So I would do not look at just 1 year of a ratio. This was just to show you how to calculate the given ratios.
I agree with you, Dr. Prescott. If the inventory turnover period have decreased from 35 to 69, as a creditor, I will step back immediately.
Well, exactly. That would scare you, no matter what the current ratio is. That's why I'm saying this is an art form. You have to take all the ratios together. You don't just focus on any one given ratio. That's my point. Okay, let's go to, sure. Thank you for the question. Let's go to financial leverage. This was a pretty easy ratio to evaluate. It is the ratio of debt or total liabilities, really, total liabilities to equity, stockholders' equity. And this, if you go to total liabilities on the balance sheet for the last year, it's 243,560 divided by total stockholders' equity on the last year end was at a 5-year low of 165,465. And when you calculate that, that is 1.47, which means creditors have put in $1.50 to every dollar invested by the stockholders. So the creditors have more at risk in this company than the stockholders do. And by the way, Dr. Sadula, I hope after this you can share with them the hard copy that I sent you of the presentation so that the numbers won't be jumbled.
Yeah, I already shared with them. They have the hard copies in front of them.
Oh, perfect. Okay, great. Okay. All right, so now this is what I enjoy. I love profitability ratios. And this is an example of common sizing or vertical analysis. So we're going to look, the first thing we're going to look at is the gross profit margin, meaning the gross profit margin is net sales minus cost of goods sold. So it's what did the company pay for the inventory versus what did it sell the inventory to its customers for? How much of a cushion is left over? In this case, now this one you have to go to the income statement, which was table 2. And gross profit is the third line down, 389,241 divided by net sales, 1,691,184, and you get a 23.02% gross profit margin, meaning for every dollar of sales, after the company pays its cost of goods sold, deducts cost of goods sold, it has 23 cents on average left over to pay its other operating expenses and everything else. Now, again, I don't know if that's good for this company. I would have to calculate this for the last 5 years to see what indeed is going on with that gross profit margin. Now the operating, yes, sir.
I'm sorry, Professor Prescott. So this is a grocery chain somewhat, right? Retailers, Fred's.
Not really. This one's not a grocery store. This is a discount retailer. It's like a small Walmart kind of store.
Right. But they have, for example, many of their inventory items, they have low margins on them. And their primary focus is volume, right? So they're trying to
Yes.
generate volume, and 23%, let's say, is there for everything else, including income tax and everything
Their
else with it, right? So
yeah, their salaries, their operating expenses, their
everything,
rent
all of that,
expense,
right?
utilities.
So the inventory is sold at a small margin. The margin between the sales price and the inventory is not that much. It's 23% here. Is that not the norm for such a retailer?
I would, good question. I would tell you that the reason I looked into this is in 2019, in September of 2019, Fred's declared bankruptcy, and it had been in existence for 72 years.
Oh, wow.
And I went to the SEC website and I pulled up its financial statements for the 5 years immediately leading up to its failure and for the 5 years before that. And I would tell you that in the 5 years before that, before the last 5 years, it had a gross profit margin of close to 28%. So 28% over a 5-year period. And now this year it's down to 23%. Even in good years, the company could not afford to lose 5% on its gross margin. And so that was why the company wound up going into bankruptcy. And really what happened is Dollar General and Family Dollar stores started moving into their communities where they were. They were the only store in town because they were in such small cities. They tried to avoid a direct competition with the large companies. And when Dollar General and Family Dollar decided, hey, we can play that game too, they started moving into these same small communities and essentially just put Fred's out of business. And and looking at these 5 years, you can see that it was a slow, painful process. And their gross profit margin was getting squeezed every single year. And they were just slowly dying on the vine. And that's why I say looking at 5 years of data is so important as opposed to just looking at 1 year. 23% doesn't sound that bad, but when you find out that its historical average was around 28%, you'd say, oh, well, this is not so good. They've lost 5% margin in the last 5 years, so this is not headed in the right direction. And in fact, you'll notice that the next two ratios are actually negative because they had an operating loss. And so their operating profit margin is actually a deficit of 8.9%. So obviously the 23% gross profit margin in this year wasn't sufficient to allow them to even be profitable. And then they did have, they started selling off assets. And so in the last year, they had a $145 million gain on the sale of their pharmacy assets. They sold their pharmacy business. So that reduced their operating loss from 150 million to the almost 13 million you see in the pre-tax profit margin. So they essentially almost broke even in the last year. But that was only because they sold off their, had $145 million. And once you sell that business off, it's not there to sell anymore. So it's over.
One more question.
So we would say, if we looked at all 5 years, I think you would say in the analysis, you would write up, these are very negative trends, and the company is no longer profitable at all. And we would not want to lend money to them. And Regions Bank was one of their lenders when they declared bankruptcy. All right, let's go quickly. Now, see, this one's all messed up. I did one on debt service coverage, showed you what we would look at. And in this company, the debt service coverage ratio wound up being 0.046. So the answer is it's nowhere near able to pay its debts. And as a result, you could see that at the end of fiscal year 18, it was only about 8 months later the company declared bankruptcy and completely gave up. And the company over these 5 years that you have had been selling stores and closing stores, going, you know, slowly but surely shrinking in size. Um, there's a company in the United States now that put out some data on Fred's when it went bankrupt, and said that it had like 50% of its stores were within 1 mile of either Dollar General and no, it was 70-something% were within 1 mile of a Dollar General or a Family Dollar competitor, and 50-something% were within 1 mile of 2 competitors. So that's what put them out of business. It wasn't e-commerce, it was competition.
There's another question, Greg, if you can go back to the previous slide. It's a question from
Okay.
Rashid. Go ahead, Rashid.
Doctor, just a quick question regarding the debt service coverage ratio. I'm trying to accumulate here a whole picture in terms of an assessment, and this came to my mind, how it's going to be benefit me in terms of assessing the situation. So just can you elaborate more on the debt service coverage ratio?
Yeah, what we take here in the numerator, you'll notice that we start with net income. In this case, it was a net loss. We add interest expense, we add lease/rent expense, and we add depreciation expense. Now, we add interest expense, lease expense, and those two because those are considered debt servicing items. And so, and net income is net of those already. So what I want to do is I want to get to what I call available for debt service. And the reason I add back depreciation expense is because it is a non-cash expenditure. When you buy a long-lived asset, say for $10,000 in year 1, that's the year that the cash flow went out. And then you expense the piece of equipment $2,500 a year for the next 4 years. So that is just an accounting measure of the expensing the cost of the asset over time. But it's a non-cash expenditure. That $42,580,000 did not leave the company this year. So I take net income or loss, add back interest expense, lease expense, and depreciation expense, and I get available for debt service. Then for debt service, I look at current portion of long-term debt. That is the principal portion of loans scheduled to be paid in the next 12 months. In this case, it was $58.6 million. The interest expense is the 7581 from up above, and the lease expense is 49,200 from up above. And my total debt service is $115 million. So with a shortfall of -5 million of funds available divided by 15 million in debt service. So this tells you if next year's available for debt service isn't greater than it was last year, we're not going to be in a position to service our debt. And the fact of the matter is they weren't. Now, what you probably will have in most ratios, they will calculate interest coverage to say how well a company covers its interest expense. But if you look here, the lease expense of 49 million versus the interest expense, and then look at the current maturities of long-term debt, they're 58 million. If you only look at interest coverage, EBIT to earnings before interest and taxes divided by interest expense, you are ignoring the two biggest debt servicing obligations for this company, which are the current portion of long-term debt and rent expense. So I don't think interest coverage for most companies takes into account the entirety of all the debt servicing obligations, especially not for this company. Did that address your question?
Yes, thank you very much, Doctor.
Sure.
Thank you.
You're welcome. And so here's what I'm saying in conclusion, is this is pretty much an art form. Usually I would say there's no right or wrong answer. Instead, when you're performing financial analysis for a bank, the goal is to assess whether the company's overall financial condition provides an acceptable level of risk for the bank. Reasonable people can and do often disagree. But in other financial analysis situations, you may work at an investment firm or mutual fund, and you're trying to evaluate a company as an investment, whether your company should recommend your clients buy this company's stock or not. And in that case, you're looking at a totally different matter. You're not really looking at debt servicing ability so much as you're looking at the overall financial condition and the trends that are going on with the company. So again, it's an art form. I think it's a wonderful career. I loved it when I did it, and I think it offers a great challenge to anyone who understands a good bit about financial statements, accounting, as well as finance. It's kind of taking accounting and finance and bringing them together and doing financial statement analysis, and I love it. I enjoy it. And when I heard about Fred's going bankrupt, and a lot of the things online were saying that it's just a victim of e-commerce, that its customers started buying these stuff online, that I knew immediately those people didn't really understand Fred's. Fred's is located in local communities where customers typically went to that store 2 or 3 times during the week. They did not buy stuff from Amazon to replace Fred's. It was Dollar General and Family Dollar coming into their markets that put them out of business. And I think I was able to determine that based on financial analysis, looking at the ratios, looking at what happened in the 5 years before, the 5 years leading up to demise, and then the 5 years leading up to the decline. It became obvious something was driving them crazy, and it was competition. Any other questions? Yes, sir.
There's a question. There's a question from Ahmed. Go ahead, Ahmed.
Hi, Dr. Prescott. I have a question on...
Turn on your microphone.
Dr. Prescott, I have a question on the profitability ratios. I need to understand from your side the operating profit, from where you get this value, and the pre-tax profit, from where you get this value. Because I checked the income statement, it's not there. I tried to make some calculation, but I didn't get this number.
Okay, the operating profit on your spreadsheet or on the document is actually operating loss, because they had a loss in all 5 periods. So it would be operating profit if it were a positive number. It's an operating loss since it's negative. And then the pre-tax profit is actually loss before income tax, because they had a loss in all 5 periods too. So instead of pre-tax profit, you have a pre-tax loss. So it's 151, 363, 111, 493, 179, 114. You follow me?
Can you repeat the last part, please, again? The numbers. From where you get these numbers? From the income taxes? Because I'm checking it now. Suppose the operating profit, it will be the SG and A expenses minus the gross profit?
No, it's all of those expenses: SG&A, depreciation, amortization, lease rent expense, and impairment expense. So it's that last line called operating loss. That if it were, yeah, it's that number. There you go.
It's different. It's different. It's not 150. Yeah. The operating loss is 242, but the operating loss here is 150. 634.
Are you looking at the same year?
The last year, 2018, right? The operating growth is on the last year, 2018, sorry.
It's not 242,414?
It's 242,414, but the operating profit margin written on the ratio is 150,634 on the slide.
I don't know. I can't see both. I don't, well, let's see, you said the slide.
On the operating profit margin in the financial analysis.
Well, that looks like operator error on my part. That's my mistake.
Okay.
And I can't, when I printed it out, it's so small, I can't actually read it. Did I get the gross profit margin right? 389,
The gross profit, yes, the gross profit is
Okay.
right, yeah. But the
Okay.
operating profit is different, and also.
Well, then I made a mistake and picked up the wrong numbers.
So you have
No,
I apologize
150.
for that. So it should be a negative 242,414
Okay.
over 1,691,184. That would be the operating loss.
Okay.
And then a negative 104,695 divided by the same denominator.
Yes. Okay.
Sorry about that.
No issue. Thank you.
Sure. Any other questions?
Other questions? Okay.
No, thank you.
Thank you so much,
There's
Greg
one
and
question.
Dr. Mustafa. Go ahead.
All right. Thanks very much, Dr. Prescott, and very much thanks, Dr. Shahryar, for inviting Dr. Prescott. In fact, it's not a question, it's just a comment, actually, about the financial analysis. Today, what I saw, actually, and we should all understand it, that these ratios is actually a gate to understand all what's going on in the organization, to figure out exactly how top management take decisions and the application of those decisions on the organization as a whole. If I take it from a broader perspective also, it's not only for the creditors to make a decision, but also it gives an indicator about the risk of the company is undertaking and how the top management is gonna manage the risk of the company. So yes, today Dr. Prescott kindly presented some ratios about liquidity, but I recall what he said, that there are hundreds of ratios, and based on those ratios, you can have what we call 360 view of the company. So thanks very much for Dr. Prescott for bringing that up. And I'm sure Dr. Shahryar is going to build on this with the students to figure out how to assess the company from within, from the inside itself. So I just wanted to have that comment, and that's it. Thanks so much, Dr. Prescott, and thanks to Dr. Shahryar, and thanks for students for taking the benefits of this presentation. Thank you.
Thank you very much.
Thank you so much, Professor. We have a student with question, Aldana. Go ahead, Aldana.
Hi, Dr. Prescott. First, I would like to thank you for giving us this opportunity to discuss and to view the financial analysis. As a banker working in credit risk specifically, we do work with the financial analysis to decide whether the customer actually, we would give the customer the loan, his request or not. And when I first started in credit risk specifically, I come from a political background, so I had no idea of financial analysis. When I was first introduced into financial analysis, they told me the first question you always ask is, will I get my money back or not? and how I'll get my money back. And from that sense, we perform our analysis at 70 to 75% focusing on the financial analysis. Then we check the other covenants, securities, also the reputation of the company, and all of that plays a role. And today's presentation has given me an overview of my daily work and what we do at work, and I would like to thank you for this. And for my classmates, whenever you do your financial analysis, just think, how can we get our money back, if you think it from a credit perspective.
Very good. Very good. Thank you. And I would say to the previous person, Mustafa, I always told my analyst, the financial statements can tell you a story if you know how to read it. So if you interpret the ratios properly, you can see what's going on in the company, and generally you can get a very good perspective on what's actually happening within the company. Whether the management has changed its strategy or altered its strategy and gone in a slightly different direction, so the margins shift. I believe very strongly that financial analysis is an incredible skill to have, and at the banking school, my partner and I, we teach that class for an entire week. So it's a lot more involved than what we've been able to do here today, but at least I hope we've given you a little introduction to the topic, and you see that there are lots of complexities, and you have to look at all the ratios in unison. You cannot just focus on one single ratio. You need to look at all the ratios together to really get the big picture.
And if I may add something to what you said, Professor Prescott, looking at a few exercises in the textbook and solving a few problems in a course is not going to give you the same thing as looking at hundreds and maybe thousands of financial statements over a period of years and years. When you just look at the financial statement at a glance, you can say something is wrong, something is really wrong. And you don't have to run any ratios. You just eyeball the financial statement and you say, I don't think I will give anything to this company, and I'm going to tell you why.
Yes, right, exactly.
Because, these financial statements come through your desk, in dozens, and you can, we call it just taking the pulse before you go into any ratio or anything. Just you can take the pulse by looking at eyeballing the financial statement, and rarely would your final conclusion would be different than your initial instinct. This is,
Exactly.
you cannot learn this in a classroom by any means. You have to get your hands dirty for a long period of time.
Exactly, that's true.
Thank
Well,
you
I've
so
really
much.
enjoyed this. I appreciate it. I appreciate everyone giving me the opportunity. I appreciate your questions. And I wish you all the best. Good luck as you progress. Someone actually contacted me today on LinkedIn and said they were looking forward to the presentation. So I was very flattered about that. And I really do appreciate the opportunity to be here, and I wish you all the best. Are there any more last questions?
Well, it's not a question, it's an appreciation for you. Can you mute your, please? It's an appreciation for you, Dr. Prescott. I can tell clearly why Dr. Shahriyar got inspired, and I think all of us got inspired as well. I might think, to shift my career. I'm 37 years old, but I don't know, it's too late for me or not, but I might think, shifting my career, because seriously, I'm really enjoying these topics. It's all about the money, Dr. Prescott.
Very good.
Thank you. Thank you.
You're so welcome. You're welcome.
Yeah.
Okay, Dr.
I just want to say thank you, and that was me, Muhammad.
Yes, Mohammed. You're so welcome. Thank you.
Thank you, Dr. Shahriyar, and thank you.
My pleasure. Thank you. All right, Greg. Thank you so much. Look forward to having you again in a future class. So with that, we will end the session. Thank
Okay.
you, everyone.
Thank
Have
you.
a good evening and a good morning wherever you are.
Thank you.
All right. Bye bye.